Good afternoon, everyone, and welcome to the second day of our workshops. My name is Nabina, and I represent Capital Markets Malaysia. Capital Markets Malaysia launched the Center for Sustainable Corporations last year, and we are very proud to be working with ERM, our knowledge partner, on this series called the Climate Scenario Analysis Series. Yesterday, we had over 300 participants join us in our first workshop, designed for corporate sustainability as well as risk professionals within the financial sector. And the workshop covered recommendations by the TCFD relating to scenario analysis and the process of applying scenario analysis to climate-related risks. And yesterday we focused on physical risk. Today we will be focusing on transition risk, and we are honored to have with us two representatives from ERM. We have Trista Chen, who is partner of ERM, and Pralabh B, who is senior consultant of ERM, who will be leading today's workshops. So just a couple of things before we get started. The workshop will run for 2 hours. We won't be taking any breaks in between. You will see at the bottom of your screen that there is a Q&A button. So if you have questions at any time, we encourage you to just click on that button to ask a question rather than to raise your hand, because we do expect to have 300 participants on today's workshop. It won't be possible to ask questions verbally, but please do type your questions in. We will also be running a few polls throughout the workshop, and we really hope that you will participate in these polls. So I'm going to hand over now to Trista. Trista, over to you.
Sure. Thank you, Navina. Good afternoon and good morning, everybody. Hello from Singapore. My name is Trista Chen, partner with ERM. And on the call with me, also my colleague Pralabh from our New Delhi office. So very welcome to our joint webinar with ERM Global. So you may think that why is ERM on the call? For those of you who joined us yesterday, that you likely have hear from my colleague Yulia and Aniket. ERM is a global organization focused in sustainability. This is our 50 years of anniversary. So we've been working with more than 50% of the global Fortune 500 clients with offices in 40 countries and 160 locations. So ERM itself, that we have set our net zero target ambition for 2025 that was recently announced earlier this year in the Earth Day. So through our 50 years of journey, we have worked with a large number of clients' organizations in supporting their sustainability movement. And throughout that, we have gained substantial knowledge, including being the sole consultant that was engaged by TCFD to prepare the technical supplement on the use of scenario analysis. So with this, today is our pleasure to share with you some of our insights in terms of the second chapter of the TCFD. So yesterday you have heard about the physical risk. And then today what we will cover in the session will include 3 topics. So first of all, we will walk you through the understanding of the drivers and the financial impacts of the transition risk and the associated opportunities. And second, we will understand the need of the scenario analysis, why companies now around the globe is increasing talking about scenario analysis. And then the third thing that we wrap up in terms of understanding our methodology in terms of how you can start to develop your scenario analysis. So with this, please join me for the first chapter of the discussion in terms of understanding the impact of financial transaction risk and then opportunities. First of all, let's take a look where transition risk sits into the TCFD framework. As you can see outlined on the scope that on the screen, that there are total 6 components of the TCFD framework. And then item number 3, identify and define range of scenarios, including transition risk scenarios and also physical risk scenarios. So when it comes to transition risk scenario, it is fundamental about identifying the suitable scenarios and mature drivers under the selected scenarios that will have financial impacts on the business, on its revenue, cost of operations, and also firm's profitability. As the risk of loss resulting from an inadequate or failed internal processes, people, and the systems, or from the other external events. And this does not include the reputation or the legal risk in the financial driver analysis process. So with this, we're going to dive into further detail in terms of what should be the scenarios and narratives we're looking at, and what would be the right approaches for you to develop your scenario analysis, including the inputs, the parameters, assumptions that you should be looking into when you consider your TCFD journey. The topic of TCFD has been, I would say, surrounding with a lot of regulatory drivers and also investors' interest for quite a while. But we still get quite a large number of requests from our clients in terms of what exactly their journey of TCFD disclosure should actually encompass. So with this, ERM now has decoded what we consider a 3 key stage for any company that you start with the TCFD disclosure. And why do we have to develop that? As I mentioned that, start from the conversation with various clients. We have here quite a diverse range of requests. And then we start to thinking, reflecting our own knowledge, including supporting TCFD with the technical development of methodology, what would be the best way to start and evolve their approach. So as advisors, we need to simplify what is a new agenda to many companies, including the new governance structure, the use of complex scenarios or financial models, and seeing strategies through the lens of climate-related risk. For many businesses, there's also a skill shortage for implementation. Although every business is different, but we see that the companies can follow a 3-step approach as we presented on the screen here. So fundamentally, the first step of the disclosure should include a baseline state of play and aspirations and plans to improve the future reporting. This may also include a qualitative climate risk scenario analysis and exploration of the base case scenario. This baseline can be built from the baseline from the gap analysis, supplemented with a competitor's benchmark to identify what would be the best practice. The second stage will be about integration. This is looking into a deeper risk and opportunity analysis to include a more quantitative aspect, including new data sets. These risks are further integrated into a corporate system and processes. Also, governance structures are also strengthened by them. Scenario analysis can be built out using public available accessible methodologies and business models in order to do the stress test. The last one, the third disclosure and beyond, should be considered as what we call investor ready. Risks are further evaluated using a more sophisticated scenarios, quantitative financial assessments in detail. As such, we can also look into performance at the site, at the asset level, or at the production line level, in terms of how the resilience and competitive advantage can be tested across different scenarios. Also, overall on the governance side, climate actions will be a more material factor in terms of assessing the executive performance and when deciding that the shareholder dividend should be considered. This will be more forward-looking into a long-term strategic decisions and targets are made with reference to the climate consideration. Also, by the time of the year 3 onwards, we also consider the disclosure should be audit ready. This should include a more consistency of commitments and statements, again, key corporate objectives, and also the full clarity on evidence based on procedures that a process that has been used. So with this, let's talk about what exactly does transition risk mean. As you probably have heard by now that the TCFD disclosure have 4 components. The first part is about the physical climate risk, which means the direct impact from the chronic climate events that my colleague Yulia and Aniket had covered with me yesterday. So when we talk about the transition risk, there are 3 topics that are covered within the TCFD framework. The first one is about policy and legal, and involving patchwork of climate-related requirements and carbon pricing at international, national, and also state level, leading to the increasing and also more volatile input costs, including some of the assets that can be carbon intense that will result into heaps of paying carbon. And then there's also the threat of securing the license to operate for some of those high carbon intensive activities. The second part will be to do with market and technology. As we know that we are in the fast phase of developing markets in terms of more renewable and also advanced technology. With those changes driven by the policy and technology, we will be able to see a more reduced market demand for higher carbon products and commodities, and also increasing demand for energy efficient, low carbon products and other services. There will also be a less disruption of market with new carbon available technology. The third part and the last part is about reputation under the transition risk analysis. There is a growing expectations for the low carbon, climate resilient actions from stakeholders, including investors, banking as the lenders, governments, and also customers. We understand there's an implication for companies' reputation that are at stake, and also the overall confidence of the management should the reputation risk of climate change is not properly being considered. There is also what is by and large more important, the implication of a social license to operate in terms of how projects or company can be accessing to the capital market. So with these three components, this is what we talk about the transition risk. And then we will be looking into details that, for example, how each component may be play out in the broader climate context. I think one of the most emerging events that's happening will be the COP event in Glasgow later this year. So with this, let's first talk about what it can mean with market and technology changes. Market and technology factors are also expected to play a very significant role in the coming years. This is driven by green choices, and also many technology developments will gain the pace, and also the cost will come down further. A couple of years ago, when we talk about the solar industry, the cost of solar panel are stopping a lot of clients to look into a more fiscal investment. But now with the development of technology, this is becoming more feasible to drive those technology development into a scalable development. So also with the improved material and energy efficiencies, this will lead to the reduction of the overall demand. Electrification also play a very important role in the shifting from reliance to fossil fuel economy to a renewable energy dominant economy. We have seen the trend by and large globally, and also very much happening in Southeast Asia where we are located. Similarly, there is also the bioenergy, hydrogen, and the other type of renewable that will support partial or complete shift of the reliance on fossil fuel discussion. As you probably have heard, the Singapore government has released a green plan, and the hydrogen, renewable, and also a more hard to abate sector, for example, carbon capture, utilization, and storage, will play a more significant role in not just Singapore, but also our global economy in terms of capturing those emissions and also transition into a more climate resilient economy. All of these factors will change the way that we look at business, how to operate currently, and will have the impact in terms of long-term strategy of the company. So when we talk about the market and technology transition risk, we will look at what would be the greener choice that are available there that will provide the market opportunity for lower carbon product and services, where would be the consumer demands shifting into a less carbon intense product and also services. And thirdly, where would be the increased demand for raw materials linked to a low carbon transition and technology. And lastly, in terms of a non-regulatory driven energy and material efficient gains, what those changes of energy mix may be looking at. So overall, we'll be looking at the deployment of the market and also driven by available technology to reduce the emission that is measured in SDS related to different steps. The second part under the transition risk will be to do with policy. Currently, we have a total of 191 countries globally that has ratified the Paris Agreement with the goal to limit the warming to below 2 degrees Celsius. In total, we have 192 countries, and together is the 98% of global GDP that have national plan to reduce the greenhouse gas emission to 2025 or 2030. With this, together, we're talking about global economy of 858 companies that has already established a science-based target to reach a net zero emission. What's more important, we're also talking about more than 2,000 companies have announced that they are already using or have planned to reduce internal carbon pricing. So all of those are being driven with the international climate policy development that is happening around the world. Together now, we're looking at 64 carbon pricing initiatives, such as carbon tax or emission trading scheme that are placed globally. I think one of that is being discussed quite widely and also have substantial contribution would be the China carbon trading platform that was launched in July this year. So with this, China starting to trade carbon in the power sector and also selectively in the chemical and the other intense sector. With all those global carbon pricing initiatives, we will be looking at a scheme covering around 21.5% of the global emissions. This is a trend that is inevitably happening globally. So under the transitional risk analysis, we'll be looking at what would be the applicable international climate policy development and how it will play an impact on the company's strategy and scenario analysis accordingly. Aside from the activity in terms of the climate policy development, we also can see that in Asia Pacific and also globally in Europe and US, we have a growing demand of companies that has made commitment. For example, aside from China's pledge to be carbon neutral by 2060 after it peaks by 2030, South Korea and Japan last year also consequently make their announcement saying by 2050, they also have carbon neutrality plan. Here in Singapore, the MAS has formalized the step in terms of climate change environmental risk management with 18 months plan by next June that financial institutes in Singapore have to disclose their climate change TCFD disclosure. I think the more important one is with Joe Biden in the office with the $5 trillion climate plan and also US net zero emission by 2050. So all of that are very much happening and developing in a fast pace. With the policies driven, it also provides the company an opportunity and pretty much requiring us to act in a very fast pace in terms of how do we internalize those policies into the corporate level and what will be the implication to us. The last part of the TCFD we'll be looking at in the transition risk will be to do with the legal. Yeah. So in terms of the climate-related litigation, I think the latest headline is to do with the Exxon climate action that goes on trial. And also the Dutch court has ordered Shell to accelerate emission cuts. What it has told us is that if companies not taking your own pace in terms of TCFD, your climate change journey, not only with the market, with the technology, with the policy driven, there can also be potential legal consequences that companies facing. So with this, let's maybe pause with the first polling questions just to hear from audience. Our event today is jointly hosted with CMM. So the first question that we have is also in a more Malaysia context. Now, after you hear that the global development movement in terms of the climate policy development and also the carbon pricing sector in the trading scheme, we want to hear from the audience that when do you think Malaysia could have carbon price and what will be the starting point we're looking at? So we've popped up a few options on the screen for you to consider. Is it a never, which is pretty pessimistic, or we'll be looking at, say, for example, by 2030, what will be the price be looking at, for example, benchmarking other Asian countries, or it will be somewhere between 2030 to 2040 or beyond 2040, but we see Malaysia likely will be going towards that direction. Okay, so the polls are starting coming in. All of us are quite optimistic on the call, yeah? By 2030, starting around $5 per ton, looking at some across the Asian countries. So this is close to 50% of the audience, things like that. It's also a good indication, indicating the intention from the stakeholder where we want to see the direction of this happening. Let's give a few more seconds for the poll to come in. We have close to 300 audience on the call, so please share your opinion in terms of where you think Malaysia as a country will have the carbon price set and when likely the starting point can be. Excellent. So combining the two of by 2030, we have a good more than 60% of majority thinking that this is the pipeline. I think this is a good indication that we will be feeding back to the organization, and then let's hope to see the development from Malaysia. Okay. So with this, let me pass to my colleague Pralabh, who will walk you through for the remaining of the presentation. Thank you, Pralabh.
Thank you so much, Trista, for a wonderful beginning to the slide pack. And the poll was quite interesting. I'm happy to understand that I think a lot of Malaysians or well, people outside Malaysia also thinking in the same lines as we are. The pressure is increasing on a lot of countries to look at climate change policies and reduce emissions, and carbon prices empirically has been found as one of the important tool to help reduce emissions. It's one of the necessary tools. It's not, it will not ultimately can do it alone. There would be, of course, a lot of other policy measures that are need to be in place to help reduce emissions in a country, but it's an important one, as we have seen in other countries and states where this have been implemented across the world. So thank you for your feedback on that poll. That's quite interesting for us as well. But to continue talking about how we look at transition risk in terms of modeling them. So TCFD does provide us framework, right? So when we talk about different steps, so I'll come to the steps in the upcoming slides, but the important point to understand is that TCFD does provide us a framework to look at. So it provides us the different categories on which we have to look at different risks and opportunities. So Trista already talked about those categories. So broadly talking about policy and legal, technology, market, reputation. And what in the end it means is there are risks under all these categories. There are opportunities across these categories, which may be an end result of some of the mitigation options that a company might look to take. But all these risks and opportunities, right? Of course, the key ones, the material ones for each business have to be placed in the risk management framework or the strategic planning to actually look to adopt the opportunity or to look at a mitigation option that can avoid a particular risk. So the TCFD framework provides us an understanding where we can actually build in these risks and opportunity into our existing risk management framework, and then look to strategize and plan how you would look to mitigate those options. But all these things will have a financial impact. And when we say financial impact, so let's say a company X operating in Malaysia are facing 5 different risks when we talk about transition risk or a world moving towards future pathway, which is aligned with less than 2-degree change in temperature. So all these will have some sort of financial risk. So when we say financial risk, so we'll talk about again, some of them, we'll give some example in the coming slides. But ultimately, when we say financial risk, what it means is that they will either have an impact on your revenues or your expenditures, which are part of your income statement, or your cash flow statement ultimately. But on the other hand, it can also have an impact on assets and liabilities, or even capital and financing. Your cost of financing can go up, and which will have an impact on your balance sheet and as well as the overall valuation of the company. So we'll try and see how some of the climate attributes impact different parts of your business, and then how we can link it to the financial impact of a company. So we have covered some only 3 examples here, just to give you an idea as to how we how companies should look at it. So we have looked at policy and legal and market factors. We haven't shown technology and reputation for the time being. But first, when we talk about carbon prices, right? So out of the poll, right, there were 50% who were saying by 2030, somewhere around $5 a ton sort of carbon prices in Malaysia. From our understanding in regards to the carbon prices implemented across other developing countries, we understand that when a carbon price is introduced, there are some allowances and deductions which are allowed, or some sort of rebate if you are doing something greener. So if you are looking at energy efficiency, the government may allow you to deduct those expenses from your carbon prices, etc., etc. So things are possible. So, but of course, for that, you need a stable government and a stable policy framework, which potentially might be there in Malaysia in few years' time. But at the moment, definitely there is the instability in the government is pretty clear. But hopefully, once it improves, right, then government can also focus its energy on looking at how it wants to move forward in terms of its climate journey. So potentially, when we are talking about carbon prices and we are talking about a $5 per ton, let's say by 2030. So a business which is high on emission intensity, right? So it will have to pay carbon prices on its own emissions. So that's one. So it will hit your operating expenditure, right? So that's, we have kept it short. We're saying OPEX, operating expenditure. But beyond that, there are other companies who may have less carbon emission production processes, or which are less in terms of intensity of carbon emissions, but they are probably using raw materials, or they are using transportation, which are actually still rely on fossil fuels. So hence the cost of those operations will also go up, because those businesses will be paying carbon prices on their businesses as well. So if you have a fleet which you have outsourced to a third party, and that fleet is, well, predominantly based on diesel, the diesel cost could go up because of the carbon prices, and in the end that cost might be passed on to you by that service provider. So your transportation cost increases, or your fossil fuel cost increases, right, or your fossil fuel based electricity cost increases. So for instance, in this case TNB, right, there's large part of power which is coal based, and so if there is a higher cost of coal that is coming through because of implementation of carbon price. So potentially, it's, if TNB is buying coal from Indonesia, let's say, and Indonesia has already implemented a $5.25 roughly carbon price. Well, it's under proposal still, but so that cost will get passed through, and TNB will look to pass on that cost to the businesses. So your electricity cost will go up as well. So ultimately, what it means is there are several business impacts. In the end, they are all impacted your operating expenditure, which is meant to go up. So even when your revenues might remain same, but your operating expenditure goes up, so your margins goes down. As simple as that, right? So the analysis is around that to understand across different time horizon. And when we talk about carbon prices, it's just that it will get introduced at a lower price, but with time, if Malaysia as a country is looking to reduce emissions even further, tighten, even have a more stringent goal in terms of carbon reduction as compared to what it disclosed in the NDCs, then potentially they will look to increase the carbon prices. So this cost over time frame will only increase. So that's where some of the scenario analysis helps, because when you're looking at a pathway which is aligned with the less than 2-degree world, the carbon prices introduction might be higher as compared to a business as usual scenario, wherein probably there is not much pressure on Malaysia to reduce emissions. Hence, the carbon prices get introduced at a later stage, or at a nominal value. So things will change across scenarios, and that's what TCFD recommends you to look at, that across different scenarios. What's your situation in a business as usual scenario versus under a SDS or a net zero by 2050. Different scenarios are available out there. So you compare it and try and understand how the financial impact would be across these scenarios. The next part is carbon border adjustment mechanism. So that's CBAM in short. And this is getting implemented in European Union by 2023. Even Trista's one of the slides was talking about it. And what it means is, so the framework is still getting exactly planned out. It's not concrete at the moment, but the thing is, by 2023, European Union is looking to implement carbon border adjustment tax, so to say, wherein any product, well, they are still in the process of defining which all industrial products would be covered under this scheme. But all those industrial products that are coming into European Union from a country which doesn't have, let's say, a carbon price, or they call it browner products. So basically, the product's emission profile is higher than as compared to the products available in European Union. That product would have to pay tax or sort of an import duty, which is based on carbon, to get imported into European Union. So in the end, what it means is either you as a supplier, so if you have your marketing arm in European Union, so you would have to incur an additional cost. The cost of your product landed into Europe will increase. Or if a buyer is buying it from you on a FOB basis from your production facility in Malaysia, Thailand, or Indonesia, then that buyer would have to incur higher cost to actually get it imported inside EU. So a lot will depend on how the cost structure are there and within European Union, and how much carbon prices or ETS certificate cost that a local business has to incur. There are some moving parts, but in totality, the operating expenditure for you would increase, or potentially it can have an impact on your demand as well. If your if your product has a very high carbon emission intensity, so if it's costing too high in European Union, some of the demand may actually wither away. So it may have impact both on revenue as well as operating expenditure. But at the moment, without any clarity on exact rules and regulations, we still feel that the largely the impact should be on operating expenditure. Revenue impact will depend on the competitiveness of your product in the end and how much cost you can pass through. But yes, definitely it will increase your cost for sure. And the last point that we are talking about here is it's from the market side. And what we are talking about is increase in demand for recycled and greener products. So what we are talking about here is, I'll probably give an example, right? A lot of European airline industry, they are looking to reduce their emission footprint. There is pressure from the government, there's pressure from the stakeholders, there's pressure from the investors. So let's say a airline company, which is a European airline in European industry, and the flight comes to Malaysia or Thailand or Indonesia, wherever, right, in Asia, and it needs refueling. So because it wants to reduce its emissions, so it will look for options which are greener in nature. So anything which can reduce their carbon footprint. So hence they will prefer, even if they have to pay a little bit more, they would prefer a product which is greener in nature, for that matter. And hence, the demand for the products which which is produced by suppliers, which has a lesser carbon footprint, would in the end be preferred by these end users. So we are talking about airline industry, but moving to other industries. So we talk about, let's say, FMCG companies or Unilever of the world, right? They purchase a lot of plastics, for that matter. So maybe for their packaging products, right? It's not only plastics, but other packaging products as well. For them as well, they will prefer products which are probably recycled potentially, because those products would have lower carbon footprint, plus any other option which is greener in nature. So any petchem product which can be used for packaging material, if it is produced from greener fuels, then definitely they might prefer to buy that, because Unilever has a target to even reduce its Scope 3 emissions. So depending on different end users, so it's not only corporates, but even individuals as well. When we're talking about a pathway towards a less than 2-degree temperature change, we are talking about a socio-economic change. So economic factors are there, but beyond that, there is social mindset which would also change, where people would prefer greener products instead of buying products which have a higher carbon footprint. So in the end, so when the end use or the market is changing, right, that would have an impact on your business. So whether it be in terms of revenue, so if your business is not greener as compared to your competitors, your revenue may face a decline. Whereas on the other hand, if your business is actually greener as compared to other competitors in your region, then potentially it can help you increase your revenue. There are both sides to the coin when we're looking from financial impact perspective, and also capital expenditure. So when we're talking about greener products, right, you have to invest in technologies which are greener in nature, and hence your capital expenditure will increase, or at least there would be a shift from utilizing your capital expenditure to potentially expand your business or looking at further things, but potentially this capex will get shifted to greener options or greener technologies. So these are the key highlights when we talk in broad sense, right? How a particular climate attribute will impact your business, and in the end, what sort of financial impact would it have on your business. And this is what we try to do when we are talking about quantification of transition risk, as to under different scenarios, how the different climate attributes would be, potentially what would be the business impact, trying to identify probably it from a subjective point of view first, and then looking at financial impact where we try to quantify it. So so on that, I'll pause for a moment so that we have two polls for you, and we'll try to gauge what's your understanding so that we can move further. Here we are trying to assess which are the key climate change related driver that you feel could have the largest impact on your business bottom line. So when talking about bottom line, it can be profit after tax. You can also consider the operating profits. It's fine. We're just trying to understand which segment you feel would have the largest impact. I think one interesting point here is that I think answers will also tilt on the basis of the type of audience that we have today. So if you are from a sector which is hard to abate and slightly more on emissions, then yes, for sure, carbon price will have a strong impact, but still, it would be interesting to see what all people think. Answers are coming in thick and fast. That's pretty good. Probably will give you another 10-15 seconds. Yeah, there's a close competition between carbon prices and the market demand for low emission products. Looks like hydrogen is slightly bit back. Technology is also, yeah, 10% to technology, 10% to reputation. Yeah, I think that's good. All right. Oops. So, sorry. Yeah, so I can see the results here. I think future carbon prices are sitting at about 33%, and the market demand for low emission products is about 30%. So yes, we'll take this input and provide you some feedback on this at a later stage, but let's have another poll. Can we move to the next slide? Yep. Yeah. So this is regarding hydrogen. So of course, there were not a lot of responses in the previous slide on hydrogen, but what we are trying to see is, do you think hydrogen is, well, most of the agencies globally are saying that hydrogen will play an important role, but which sector you feel hydrogen will have the most significant role to play when we're talking about energy transition?
Pralabh, if I may add, this is
Sure.
also a question quite interesting to understand the Asia Pacific audience inputs. For example, in Europe, where the iron and steel sector are relatively aged and dated, but technology hasn't been transformed into, for example, electric arc furnaces, like some of them, in China, Korea, and Japan. Hydrogen has been considered a centralized fuel source in order to go through the energy transition from some of those iron steel plants, right? So we also see that this perhaps may not be the case in Asia Pacific because we have gone ahead of that curve in some of the countries. So let's just see what the audience will say in the sector that they think. Yeah.
Yeah, not true, especially when we talk about developing countries, right? So there's still a lot of steel demand expected in these countries. And when we talk about DRI, electric arc furnaces, they have limited capacities, right? And BF has definitely, they can expand a much higher in terms of setting up one plant at one place, right? So yeah. A lot depends on how the economies are placed. But interestingly, I think more than 40% people are saying that the transportation will have power sector will have the most important role when we talk about hydrogen. So we are talking about potentially, yes, there is, so first we actually use electrolysis to produce hydrogen, which is an power intensive process. And then possibly we use the same hydrogen to produce power. So that's one. But other part is that, yes, hydrogen can actually act as a storage, wherein, renewable power, when it's at its peak in the afternoon, can actually generate some of the hydrogen. And then you can use hydrogen at a later stage when probably solar is not available to generate electricity and supply it to the end users. So yes, there are two ways to look at it when we talk about power sector. Transportation, yes, some of the, especially the heavy duty trucking, definitely may find it difficult for electrification, because if you have a short haul truck with the lighter tonnage, possibly yes, electrification is an answer. But when you talk about heavy duty with high tonnage and long haul trucks, hydrogen may potentially play a much more important role. And even beyond that, when we talk about maritime industry, difficult to reduce emissions. So I think that's where also green hydrogen converted into green ammonia is expected to play some role. So yes, agree with the audience here on the poll. Interesting views. I don't feel power should have that much usage for hydrogen, but again, that's my personal view, so it doesn't matter. But refining petrochemicals will play an important role because they depend on hydrogen. Right now, the way they produce hydrogen, it's quite carbon emission intensive. Potentially, they may have to look at greener ways to produce it. So how will it come will depend, of course. Technology readiness level is still early stage when we talk about especially the green hydrogen. Well, technology is available, but not deployed at commercial scales at the moment. But thank you for your responses. Interesting result for sure. Let's move to the next part of the slide pack. So here we talked about briefly as to how we approach quantification of transition risk. But when we talk about scenario analysis, right? So out there are so many scenarios available, right? And which ones people are typically using, why they are using it. I will try to answer it holistically. Of course, there are a lot of specifics that may go into selection of each scenario. But beyond that, how we conduct scenario analysis, or why scenario analysis, right? Why scenario analysis altogether? So when TCFD talked about scenario analysis, right? It's basically trying to tell a company that the future can be very different, and we are talking about a very long-term analysis. So just looking at forecast on one dotted line or looking at sensitivity analysis around forecast, it may not serve the purpose. So what we by use of scenarios, what we are trying to do is, rather than highlighting, as the second point says, rather highlighting central elements, well, the aim is to highlight the central elements of a possible future and to draw attention to the key factors that will drive future developments. So we are looking at key parameters, key signposts so the pathway to the future is, if you're looking at a less than 2-degree world, yes, you have some trajectory in your mind, but that pathway can be achieved by different moving paths. It's not that you need to deploy one option or you need to look at one mitigation options, but when you're looking at a future, right, and this future can be different as well, right? Because based on your understanding of the events happening around you, the future would be different, and how you would approach that future or achieve that future pathway, the things can vary across different companies, across different geographies, across different sectors. So so the important point, I think, the one to highlight here, which is important from a long-term perspective, is, so when we talk about forecasting, right, we are just looking at one direction to the future. So we are looking at, okay, this is going to happen, and this is how our business would be in that case. When we're talking about sensitivities, we are looking at around forecast, what are the different sensitivities, right? If let's say coal prices or the fuel prices go plus 10%, minus 10%, then what's the impact on your business, right? So that's a little bit of sensitivity. But when we talk about scenario analysis, so basically here you have one particular view of the future, but here you have 3 different views of the future. You have 3 different world. You may have more. You can have different views of the future world, and then there are different pathways to achieve all these future world that you have in your mind. And these different pathways can crisscross each other. They can overlap. They can have different signposts. So starting on one path, you shift to another one at a later stage because a particular signpost changed. So that's why the scenario analysis become important, and especially when you're looking at long term, you're looking at issue focused driven forecasting. You definitely, scenario analysis is much better than looking at doing forecasting studies or doing sensitivity studies. So this is a very interesting framework. It was actually developed by Shell, but we definitely feel it's an important one to keep in mind when we are talking in terms of why scenario analysis. And when we look at scenario analysis, so we are looking at from two angles, right? So one is physical risk, which is when basically the temperature change is extreme. So that was discussed yesterday, right? When we're talking about an RCP 8.5, this is greater than 4-degree business as usual scenario for IPCC. Now, under this scenario, the impact is more because of physical risk. So because transition did not happen. When we're talking about business as usual, you're talking about continuity in probably the coal-fired plants that are already there. You have transportation vehicles which are still mostly internal combustion engine vehicles. The efforts to reduce emissions are basically paltry or low. They're not changed, according to newer policies, but basically depend on existing NDCs. Hence, the temperature change is high. So what it means is that there is no transition that has happened. Nothing changed actually. So things have not moved to renewables. Vehicles have not moved to electric vehicles or fuel cell electric vehicles, and so forth. So what it meant is that the temperature increase is high. So ultimately, it will have a physical impact on your businesses, and that's what was discussed yesterday. So that's one side of it. But on the other side, when we talk about transition risk, we are actually talking about a place wherein there's a rapid change in the way we have been working on things. So there is a higher penetration on renewables. There is high level of efforts to curb emissions. You have emission captured at a large scale. You have high use of public transport, which is much more greener, and you have electric vehicles, high usage of cycling potentially. But yeah, so these are just some examples. But what we are talking about is there's a much more effort in terms of moving away from the way we have been doing or conducting our business to greener way or to greener solutions, plus the social impact or the socioeconomic, as I coined earlier. There is a social change in thinking of people to actually utilize and use greener products, right? And so this trajectory is what it means from transition risk perspective, as the things are changing in this direction. And we are trying to understand from scenarios. So when we talk about scenarios, so we are looking at business as usual, where potentially the transition risk impact is limited. So your base case forecast remain the same, whereas under a low temperature change scenario, a low carbon economy scenario, the transition risk will have a much higher impact. And when you start looking at these scenarios in between, you will see the impact varying based on how the world is moving in that direction. So yeah, so again, to highlight the same point, but in a slightly more different way. So we are talking about global emissions going onto this trajectory. If we are looking at 1.5 degrees, so this is adopted from IPCC scenarios, right? Whereas business as usual, the emissions goes on increasing, yet the temperature change is much higher. But when we're talking about emission reduction, right, just look at the steep decline that is required, especially when we talk about 1.5 degree. So this is very sharp. Of course, new reports have come out, and potentially they are even looking at even a sharper decline in terms of emission reduction. But when we are talking about this decline, there needs to be a lot of changes happening across countries, across companies to achieve these targets in the future. So do keep that in mind when we talk about some of the numbers and the impact at a later stage. But yeah, so coming back to the scenarios, right? There are a host of scenarios available out there. So starting with IEA, which is probably the most common one, there are IPCC scenarios. IPCC is looking to come up with new range of scenarios, which should be published soon. There are NGFS referred to by a lot of financial companies. Then you have OECM or a PRI, which is the inevitable policy response, IPR scenarios. Now, if you look at their years, right? So of course, 2020, some of some of these scenarios get updated on a regular basis. So you have updated version available, but because things have changed, especially after COVID impact, so the scenarios that you may see coming forward, coming out now, might be starting from a different base altogether. So it's important to look at these scenarios from the first important point is to look at how latest they are and what's the base starting point and how the growth rates are looked at, because it's important to understand which year they are starting, because that can change your trajectory a lot when you're talking about forecasts. So important one to keep in mind, what are the starting year and what are the base assumptions that they have. So but when we talk about IES scenarios, I'll talk about IES scenarios a little bit in more details, but just possibly going to IEA. Before going to IEA, I'll talk about the other scenarios. So when we talk about IPCC scenarios, so a lot of them are looking at the full form is representative concentration pathway. So they're potentially looking more at from a physical risk perspective rather than transition risk perspective. So if you look at the details, you may not find it easy to use them for a transition risk quantitative assessment. And that's the story with a lot of these models. NGFS is still fine, but even PRI to a certain degree is quite useful. But the amount of data availability under the IES scenarios, especially from transition risk perspective, and at a slightly more segment level or sectoral level, or at a slightly more, you say, regional level, the availability is much better in IEA as compared to other scenarios. But again, a lot will depend on how in depth you want to do this analysis. So some of the high level analysis can definitely be done with depending on which scenario you want to pick up. But when you're looking at quantifying it potentially at a corporate level or at some even product level, so some of the times I think we understand that IEA scenarios have been useful, and that's why if you look globally, the use of IEA scenarios has been much higher as compared to other scenarios when we talk about transition risk assessment. And
hi, Pralabh. We do have a number of questions just pop up to do with this slide, so I thought it makes sense for us to answer that when we still have the screen share. Yeah, so one of the questions is that you also answer that the scenario choose varies, right? So the question is that how do you decide which scenario to use when running a scenario analysis? Is there a rule of thumb that we would recommend?
Sorry, I couldn't get the last line.
Which scenario that we should recommend to use when running a scenario analysis? Notice that many financial institutes use SDS scenario by IEA. What is the reason and consideration behind that?
Yes, thank you for that question, and thank you for bringing it to me, Trista. So yes, as I said, right, when you are looking to do a little bit more deep dive into transition risk assessment and quantifying it, that's where SDS and steps are used as the base scenario. So steps is the business as usual scenario, which is here, whereas SDS is sustainable development scenario, which is more or less Paris Agreement compliant, looking at a less than 2-degree change in the temperature. So why these have been preferred? Of course, the update frequency is annual here. So they provide a much updated view. Second, I think the in-depth details that they provide, at least on the sectoral level and beyond that, even looking at, as I said, regional level, is much better in terms of availability, is much better in IES scenarios as compared to some of the other scenarios we are talking about here. But even beyond that, I would say when we talk about physical risk, we don't tend to use IES scenarios much. In fact, we rely more on IPCC scenarios because they provide much better visibility on physical risks. Again, a lot will depend on what's the final output you would like to see. And if in fact, if you're looking at a very high level transition risk, we are talking about, let's say, heat map level assessment, you can potentially use NGFS, OECM, or even PRI. So of course, some of them get tilted. So even going beyond this list, when we talk about Greenpeace and IRENA, they try to find out, and a lot of their focus is more towards renewable and electrification. So of course, there is another angle to it. So it's a very customized approach that has to be taken based on each company's company's sector, company's requirement, and the geography as well, actually. So there's no right and wrong here, but it's more about what's your final requirement, and based on that, you should actually approach a particular scenario. But when I say that banks are typically using IASDS, because it's, again, as I said, it's been utilized by a lot of companies globally, because from transition risk perspective, it gives a lot more details when you're trying to quantify the transition risk.
The second question, thank you, Pralabh, is that we didn't list the beyond 2 degrees scenario under IEA on the list. Is there a reason not to mention it here, or we just have a very sample selected as presented on the screen here?
Yes, a very simple list, a very short list. There is a big list definitely out there. But what we understand is that I think TCFD also is looking at recommending some of the scenarios. How will that be placed? Not clear at the moment. But potentially once it's out there, then it might be easier for company to look to adopt it, because this is a common question that we face, and I'm sure TCFD would be facing as well. So I think there would be more guidelines coming through in potentially this year or early next year.
Sure. The next one is that what is the difference between RCP and the SSP, shared socio-economic pathway of the Ipcc?
Yeah, so the SSPs are probably the ones which can be used more for transition risk now, because they have a little bit more in-depth analysis. So as I said, the social part is missing in Ipcc scenarios, which are there in IA scenarios, and potentially after these SSPs come through, the potential for Ipcc scenarios would definitely improve in terms of analyzing them from transition risk perspective as well.
Yeah, the last one before we move forward is a lot of discussion, is that when you say that choosing the scenarios based on the sector, geography, the technology product, right? Do we ever use a mix of different scenario providers, for example, using SDS and Ipcc to cover the holistically both the transition and also the physical risk together?
Yes, definitely. So when in fact, we have live examples. So we are working with the Malaysian and Thai companies, or even Indian companies, and we are doing that. And of course, we explain the basis of that so that they understand why we have used Ipccs for physical risk and what other background information is available there. And then we also explain IA scenarios, right? And so we will be talking about IA scenarios in the next slide. But definitely, as you said, we have used them together, and of course a lot depends on how company wants to look at it. Some of the companies have asked us to look at the IRENA scenarios, and we have looked at it from that angle also. So because they believe their philosophy was that electrification will play a significant part, and of course not a very emission intensive company, but we have done scenario analysis using that as well. So it depends, again, as I said, it depends on different factors and what company is looking at, their strategic position, what's their final requirement. But yes, it can be a mix, of course, depending on the viability of each scenario. All right. Thank you so much, Trista. So I'll talk about some of these scenarios in the next slide as well, actually. So when we talk about IA scenarios, which are the most commonly ones, so the important points to look at is, so when we are looking at transition risks, right? So depending on company's appetite, we try to, of course, we use STEPS, which is the stated policy scenario, as a business as usual case. So the temperature change is expected to be more than 2.77 degree under this scenario. And what it means is that, you know, it's based on the current policies which are already in place. So it just plots the trajectory of emissions based on what are the current policies that have been introduced globally. So you can potentially consider only the NDCs to be considered under this scenario. But when we talk about sustainable development scenario, when IEA says that under sustainable development scenario, which is Paris compliant, leading to a reduction of less than 2-degree change in the keeping the temperature change to less than 2 degrees, the world needs to reach net zero by 2070. That's the trajectory that IEA has come up with. Now, as part of that, it says that if the net zero pledges which are there, EU, UK, New Zealand, others, if they are met, so the dark blue portion will reduce from business as usual if these net zero pledges are met. And then further, IEA says that if China reaches its net zero statement, it's not committed, it's not legally binding at the moment, of course, it's a pledge. it's a statement actually. So if they reach it, then definitely this big chunk will come down by 2070 in terms of emissions. And then further, some of the policies which are not there today, but when SDS, we are talking about SDS, it takes into account some of the future policies that would be needed to actually achieve net zero globally by 2070. So these emissions are expected to come down from other countries which have not committed or even talked about net zero at the moment, but in the future they will commit or look to commit for net zero. So for instance, Thailand as the country is looking to is committed to 2065 now for net zero, which was not there when IEA came up with this scenario. So something on those lines, when other countries keep on committing or voluntarily reducing emissions to reach net zero by 2070, so this would be needed as well. So my apologies. So basically IEA says that to reach net zero, these are the reduction in emissions required across different geographies so as to achieve net zero by 2070. But even beyond that, IEA has come up with NZE or NZE 2050. And what it says is that if you want to reduce the temperature change to 1.5 degree, the trajectory should be even lower. And what we are talking about is reaching net zero by 2050. So hence, this trajectory is definitely very steep. And when we talk about these scenarios, right, and when we talk about transition risks, so what we are talking about is, let's say, carbon price under business as usual may not increase significantly in the future. I don't remember exactly the carbon price assumption under steps, but it's much lower. But when we talk about SDS and we are looking for a lot of countries to reduce their emissions, so the carbon prices are required to be at a much higher level. So if I am not wrong, I'll just try, I'm trying to recollect some numbers. I think $140 for developed country was the carbon price under IEA SDS. And for some of the developing countries, it was about $125 a ton. But under net zero, it's expected to be even higher, and certainly under SDS, some of the developing countries, it's not clear, but they are not expected to have very high carbon prices. But under net zero, even some of those developing countries are required to have carbon prices to actually achieve this this reduction. So what IEA says is that, you know, it's not that the world is moving across some of these pathways, but what IEA says is that if the world needs to reach a particular or limit the temperature change to a particular level, then what's the trajectory a world needs to achieve, and then on basis of that, if world is looking to move on to that trajectory, then how it will impact the businesses. That's what we are trying to analyze here. So a typical approach that we take, so first we are talking about example for a portfolio company. I should actually probably talk about this slide first. Sorry for that. But talking about the approach that we take or the steps that we take for doing analysis, right? So I'll talk about corporate analysis first. And what I'm trying to talk about here is that how we delve into analyzing or doing scenario analysis for a company. So what we do is, this is definitely a deep dive into various drivers, how they are impacting different segments. So we talked about how climate attributes are impacting business, how they have an impact on the business, and then how finally they are having a financial impact. And depending on the scope, the analysis objective could range from you know, estimating impact on a particular product to a company as a whole. So hence, what we are trying to see here is a little bit more in-depth study on how the different climate attributes will impact the company. So first step, we identify the risk and opportunity drivers, you know, across the different categories that ITCFD provides. So market and technology, policy and legal, reputation, risk drivers. Based on the drivers, and then we actually, so once you have identified the categories, the drivers, then you look to prioritize them based on materiality, right? So that's the first assessment that we do, the materiality of the different drivers. And once we have identified the prioritized driver, then we look at the scenarios and the scenario sources and what all data is available for those identified drivers under the different scenarios. So giving an example of carbon prices, right? So IEA prescribes what carbon prices we should look at across different geographies under the different scenarios. So we pick up that data. And if it's not available, let's say for a country like Malaysia, it's not available, then we try to conduct workshop with the company and try to identify what they feel could potentially be the carbon price in country like Malaysia in the future. And that poll, the poll that we had also helped us to actually understand what's the view of the people in the industry in terms of what sort of carbon prices might be there. So we engage with we look at empirical study, we talk to institutes, we try to talk to ministries and try and understand, what's the view out there, not only for carbon prices, but for other drivers as well. And of course, we do a lot of secondary study to understand what those different drivers may mean for Malaysia. So talking about electric vehicles, for instance, right? At the moment, the current policy for Malaysia is looking more towards hybrids. And hence the pure play electric vehicles is not in the picture at the moment. So potentially the impact of electric vehicles in Malaysia on, let's say, diesel and gasoline demand or increase in electricity demand may still be a little bit further away. And hence, the impact of electric vehicles may only come in medium to long term rather than short term in Malaysia. So these are the things that we typically look at and try to quantify them as to what's the directional impact could be. So out of the total fleet of car sales or vehicle sales in Malaysia, then what proportion is expected to be electric vehicles, or how much impact could there be potentially on different drivers of these drivers on a company's portfolio. So once that has been done, once we have got some data from scenario sources or public sources or through our workshops, then we try to obtain the data which is relevant from a company perspective. So when we're talking about electric vehicle, for instance, right? So there are different parts to it. So how much exposure does a company has, let's say, a refinery into gasoline and diesel, which goes into the vehicle segment, right? And based on how much electric vehicle penetration would be there, it will have an impact on the company. But we need to understand from company's perspective how much of its portfolio might have an impact. So in terms of volume or the total revenue getting generated from that angle, or from another side, maybe electric vehicles is made up of steel, aluminum, or plastics, right? To improve efficiency, maybe in the future the plastics demand going into electric vehicles might increase. So how much capacity, let's say, a petrochemical plant has which can produce electric vehicle parts. So that's the thing that we would need once we have identified a particular risk driver. Once we have got some data from public sources, then we try to align it with the company's setup. So that's where it's a very interactive process, and it's a co-creation process, as we typically say, that we have to work closely with you and you have to work closely with us so that we can get an estimate exactly for a company's perspective, not from, at a high level. And then, of course, based on the inputs that we have collected from different sources from the company, we generate a model, we run output, we create dashboard, and we show the output in terms of how it may impact your revenues or your EBITDA across different scenarios, and based on what we feel would be a penetration in a country. So this is a corporate approach where you can dig deep. Of course, needs to have much more time allocated to it, a lot more efforts. You can have a high level approach wherein you can do slightly more heat map kind of analysis, which we talk about for the portfolio analysis. So when we are talking about portfolio analysis, we are talking about big financial institutes or companies that have a long list of businesses. And when we talk about their businesses, it may be spread across different geographies, across different sectors. So the moving parts can be huge. So if you are willing to devote a lot of time in this kind of study, yes, this can be done in terms of detailing it. But a typical approach is where we actually do a heat map kind of a study. And we'll talk about a little bit more in terms of step in the next slide. But when we talk about portfolio analysis, in terms of alignment with corporate analysis, steps are same, but we keep it a little bit more high level. And we talk about identifying the key scenario indicators, right? We talk about applying a weighting to each indicator. So when we talk about weighting, right, a particular driver that we have identified, like let's say a carbon price, or let's say a CBAM, or let's say an electric vehicle, or let's say hydrogen technology development. we try to see how these factors could impact a particular sector. So as we said, we were looking at hydrogen impact on different sectors, right? So that's what we try to analyze and understand how significant a role hydrogen will play in a particular sector. And we provide a relevant weighting to it to understand whether development of hydrogen could potentially have a similar sort of the correlation of the impact on a particular industry, let's say, would be 100%, or would it be 50% impact or a 25% impact? So it's a little bit more subjective exercise, but it's tried to identify and look at the risk at a more subjective level rather than quantifying it at a very granular level. So here it's a very detailed approach. Of course, we have proper models on it, but it's a little bit more high level and a subjective approach, because there are a lot of moving parts. But it's very this study actually helps very nicely to understand what's the impact across a large portfolio for the company. And then we do it for each sector, for each driver. We align a relevance weighting. Then we get the data from the scenario sources or the public sources, and we try to identify the deltas here. And when we say deltas, what we're trying to say is, let's say the hydrogen production, if it is going to increase significantly in a particular scenario, then we try to identify that delta and apply it on the sector weighting to get a number which gives us an idea of how much potential risk or opportunity a particular sector will face using these two parameters. And once that has been done, once these inputs have been put in, once we have got the sources from the public documents as well as from the company, then we actually run the model and show a risk weighting or a summary heat map, which we present typically to the clients to explain them why a particular driver is impacting a business at a particular scale and by what time horizon. So on that, I'll talk about some of the steps that we take typically for the portfolio analysis. So as I said, right, most of the time you have companies which are spread across. So when we're talking about portfolio analysis, your investments might be spread across different parts of the world. So whether you are looking to do a global study or you're looking to do a regional study, because even when we talk about IEA numbers, right, or IEA scenarios, so they do give us some idea on what's happening globally and what's happening at a regional level. Because when you're talking about regional portfolio, especially from a transition risk perspective, it will differ from region to region, because the speed of transition would be much faster in Europe, for that matter, or potentially US, as compared to some of the developing countries in Asia. So hence the impact by 2030 of transition risk for a company which is operating largely in Europe would be much higher as compared to companies operating in Asia. So hence you have to look at those pockets and the company needs to decide whether they want to do a very high level, just looking at global, how the transition is happening globally, or they are looking to do it at regional level. Then you look to identify which are the key scenarios that you would like to utilize. Of course, again, as I said, a lot of times IEA is getting utilized because of its utility. Then you identify the material issues or the drivers across the different categories that are there under TCFD. The next step is where you look at, base case versus the selected scenario, which is less than 2 degrees. What's the difference? What's the delta? You apply you apply the risk weighting for each driver across different sectors, across different time horizon, and the output you'll get is sort of a heat map wherein across different indicators or across different sectors, you will see what are the different risks and opportunities for the company as a whole. So this is a quick approach which can actually help you identify when you're starting on TCFD journey, right, as a company or as a entity which has a big portfolio or a big conglomerate that can actually kickstart your journey on TCFD, where you try and understand from a high level what are the key risks and opportunities across different indicators, across different businesses, and across the different time horizon. So that's what is the output of this study. And then when we talk about corporate analysis, so a little bit more in depth, wherein you will get detailed dashboards as well. So this is just one simple example where we're trying to show you how introduction of carbon prices could impact your operating expenditure across different two scenarios, which is business as usual, which is probably aligned with steps. And another one could be a less than 2-degree world, which is potentially can be aligned with SDS. And hence, because of introduction of carbon prices, potentially your business would have to pay higher costs to the tune of this much over the long term. So this is a very simple and sample illustration that we are trying to show you, but based on what I have talked about in terms of quantifying it, this is how you can get some output. So this is from a carbon prices perspective, because it leads to higher operating expenditure. Then potentially we are looking at how much OPEX increase could be there. And then, of course, this is more from portfolio, back onto the portfolio side of things. When we are looking at, let's say, a portfolio across so many sectors, across different time horizon, the risk, the sectors that will face the highest risk when you're talking about transition risk, what is the sectors that can provide you, opportunities, and probably some of the sectors stay neutral. This is kind of heat map that we can come up with using our tools, in-house tools, to give you a high level view of, what are the risks that are there for your businesses. So
Pralabh, before we
Yep.
go into the polling question, there are also some questions regarding to the corporate analysis that you mentioned. Maybe you can go back to the slide earlier. So one question is about that, whether we have a corporate analysis and based on exposures at the corporate level of the company, and then deep dive and conduct a portfolio level analysis.
Yes, so that's what I said. So at a high level, when you're talking about a company level analysis, so you're looking at more on materiality of different transition risks, and then you look to create a heat map. So and as part of, additionally, what you can do is incorporate some of the risks in your existing risk management framework based on the likelihood and the impact of different risks. So this is something which we conduct at a high level, wherein we identify the key risks across the categories that we look at from TCFD point of view. Then we talk about what is the description of the risks. We talk about what's the potential impact. So as I said, right, let's giving an example of electric vehicle. So if in Malaysia, the current policy is not looking at, 100% electric vehicles, looking at hybrids. So the potential impact of electric vehicles by 2025 is limited. And if that is one part of your business which is going to get impacted because of the penetration of electric vehicles in Malaysia in the future, then that's what we try to identify at a higher level, and it's a more of a subjective approach where we try to see likelihood. We say, okay, by 2025 the likelihood of electric vehicle impacting your business is very low, so we give it a rating of 1 to 5, and we say, or if you have an existing risk management framework which provides us an idea of what's the rating of 1 to 5, what's the probability we need to assign to different risk drivers, we can use that. And then once we have identified, okay, by 2025, the likelihood is very low. Okay, impact would be very low because the likelihood is low. But when we talk about, let's say 2040 for electric vehicle penetration, and it has an impact on your business. So then what we look at is by 2040, let's say in Malaysia, the electric vehicle growth is aligned with the view for Asia under the IS scenarios. And if the penetration is, let's say 30% or 50% of the the vehicles sold is electric vehicles. So this we're still doing at a company level, but what we try to understand through our workshop is, do you feel that the electric vehicle, the segment or the portfolio in your business which is getting impacted because of electric vehicle is, let's say, less than only 5% of your business, right? You know those numbers. So we are not getting those numbers, but we are still trying to understand from a workshop standard point of view. If you feel the impact is going to be low, so even if the likelihood of impact is high, because Malaysia is looking to penetrate 50% of car sales using electric vehicles, so likelihood is high, maybe 3 or 4, but potentially the impact might still be low because the overall portfolio which will get impacted because of electric vehicle is only 5% of your total revenues. So the impact is low. So even then you can keep it, let's say at a rating of 1 or 2. So this is how we do a slightly more high level subjective approach through workshop mode, where we don't deep dig deep into the numbers specific to your each individual business unit, but we look at it at a company level in a more subjective way using your existing risk management framework, so that once you have identified the risk which might fall into 5 category, which is the red zone, the highest likelihood and highest impact, you may actually look to include it into your existing risk management framework and then try to track it over years. So this is one first approach, and then only then we delve into the next stage, which is more deep dive. Because if you are starting on your TCFD journey, if you start right away into deep dive, you may actually, some of your stakeholders might get confused. So it's a journey that we take, and Trista actually talked about it in 3 steps in one of the slides. You can refer to it, and you can all probably drop us an email. We can get back to you. But yeah, that's the first approach. Sorry for the long answer, but it has to be explained.
Yeah, one of the, I think we already answered that in a way. The question was that whether we help to conduct a scenario analysis for the company. I think the answer is yes. And in case a bank or asset manager, does CRM help to get that asset level data from their portfolio running the scenario analysis? I think it's yes and no, depending on whether the data is available or not, right? And what is the ultimate objective the client wants to get out from the scenario analysis.
Yes. So when we talk about banking sector and their portfolio, they are huge, right? So ultimately, it's a very time-consuming process. But if you have a focused approach, let's say a bank needs to focus on a particular sector or a particular geography, that deep dive can still be done. But the other part is how much transparent the company might be, because it's not, we are not only relying on publicly available data, but we need company-specific data which might be confidential. So yeah, so a lot will depend on practicability and the requirement of the bank to look at that analysis. So if it is a due diligence, it's a different thing. There, I think Trista can explain a lot. But yeah, if it is something else in terms of looking at TCFD purely from a banking perspective, then yes, I think the initial starting point definitely would be a heat map rather than deep dive, because yes, a bank may do deep dive in some of the sectors that it may feel they are risky in terms of transition risk. But yeah, when we're talking about deep diving for the entire portfolio, that's a long-term project. You may need to have an internal team as well for that.
Yeah, thank you, Pralabh. We
So,
still have a few questions, but we can leave those to the end.
yeah, it's we are actually coming to last few slides only. But before we go into that, just want to understand, right, what people could actually make out of what I was talking about. So I used a lot of financial terms. I tried to explain how we look at how climate attributes impacting business impact and how it impacts the financial things in a company. So it's a simple question, but would like to understand, to understand how were you able to digest what I was talking about? This question is simple, but really like to see if some people can respond. It's a financial management, going back to school days, trying to understand how things can impact from a transition risk perspective. Yes, some answers are there now. We have got 16% participants responding. Oh, it's increasing, so probably give some more time. Oh, yeah. People might have taken out calculators. Yeah, or maybe Excel files. Yes, much faster these days.
You have brought us back to that it's TCFD, there's the F there. So it's not just the C, yeah?
Yeah, that's right. Yeah, interesting. So how many? So 2 minutes have already passed. We can probably end the poll here. Yep, thank you. I got answers. 11% of the people answered it correct. So I'll explain it, right? How we approach it, basically. So when we're talking about 1 million ton per annum, so it's considering the emission remain the same, right? We have additional cost of 20 million ringgit in 2030. So basically, the initial costs were 100 minus 40. So the operating costs, we're just looking at operating profits and operating costs at the moment. So the operating cost was 60 million and whichever year we have provided this information. So, and then that cost increases to about 80 million now because of the carbon price, right? So if we have looked at irrespective of any pass through to the end consumers, the revenue would have remained same, which is 100 million. But the costs have gone up from 60 to 80 and your margins has gone down to 20 million ringgit now, which is just a 20% profit basically. But when I said that, that the company is able to pass through about 50% of the higher costs, so the increase in cost was about 20 million. So out of that, let's say 10 million has been passed through to the end users, and so the revenue increases to 110, whereas the costs remain at 80 million Malaysian ringgit, right? So the profit is 30 million and your profitability is 30 by 110 or the operating margins, which is about 27%. So yeah, that's the answer. So thank you so much for everyone who answered it correctly, and to the others also who couldn't answer it. I know it's a little complicated, especially the language, but it's a very simple approach to look at how it's impacting our business. But when we look at models, right, when we're looking at a deep dive, then definitely a lot more comprehensive models are there, which can be created based on the requirement of the company. Thank you for that. Some of the key messages before we jump on to the questions. So when we talk about a global transition, which is toward a Paris Agreement compliant world, it definitely needs a lot of changes how we conduct our businesses or how we conduct ourselves, right? Everything. A lot of things need to be changed if we want to move into that direction, and that's what this transition risk is all about. And different climate attributes will actually present themselves as a risk as well as opportunity, depending on how company is looking at it. So if you are looking to strategize, if you are looking to mitigate, some of these can definitely become an opportunity for you, even if there are risks for you at the moment. So when we talk about transition risk journey, it's not only identify the risk at the moment, but also look at residual risk once we have taken into account the mitigation options. So that's another part that can be done, or another extension that can be looked into beyond only from TCFD perspective, but beyond TCFD as well. And these attributes will have a different impact on the financial metrics of the company. And that's what TCFD says, that you need to analyze it, understand what are the risks to your business, what are the opportunities, and potentially disclose them based on, the level of comfortable, the comfortable level that you feel you're willing to disclose out there in the public. But it's very important to keep on informing your stakeholders these days. They are very interested in understanding it, whether they are internal stakeholders or external stakeholders, depending on what you feel is right to be shared with them. It's becoming increasingly important now, and I'm sure Yulia would have talked about about this in yesterday's session as well. Then beyond that, assessing the risk and opportunities from these drivers across different publicly available scenarios actually will help you understand the business resilience, or if or on the other hand, the future strategy that you may need to adopt. So these things definitely help a company. We have worked with a lot of companies in Asia, and we have understood that how some of the companies which have climate change as one of the risks and have looked to understand it from not only TCFD perspective, but from independently also looking at climate related risks, they have fared much better, and they are probably much more ready to face a world which is moving towards a Paris Agreement compliant trajectory. And then more detailed studies, as we discussed, these can be delivered. We can perform them in ERM, and This helps in increasingly quantifying it and to actually look at from a cost benefit analysis of looking at a particular mitigation options and what are the benefits that may arise in terms of avoiding carbon emission cost or increasing your market share in a world which is looking for greener products. So we can easily compare what is the cost of particular technology and what are the benefits that you may get by adopting a particular mitigation options. So these can help you take financial decision making in the future. So some of the key points here, definitely for you to take home and look at from your company perspective. So yeah, on to the Q&A now. So Trista, I'll open it up for our Q&A session now.
Yeah. Thank you, Pralabh. We do have some early questions that we haven't answered. So let's use the time allowed. Let's just go through them. So the first one is that imagine it's a corporate that they have different facilities in the same sector and location. Would the transition climate change risk be the same if they're in the same sector and location, even though they are different facilities?
Just the transition risk, right?
Yeah.
Yeah. So same sector, same location, a lot will depend on the carbon intensity. If a unit is 50 years old versus the second unit is 20-year-old, just a big example, but definitely the energy efficiency and the emission intensity of the older unit would be slightly worse as compared to the newer unit. So the impact on that unit would be much higher, where you talk about in terms of operating expenditure increase because of carbon prices, or if you look to adopt a technology there, it might be much more costlier to reduce emissions. So instead of potentially looking at replacing parts in a very old setup, you may actually look to set up something completely new, which could be much more expensive. So the approach, the cost, the impact would differ, even if it is within the same sector at the same location. But if they're the age of the setup is slightly old, and again, a lot will depend on the energy intensity of the business. So if in intensity it's in a service sector, then it's a different ball game. The impact is very minuscule. Whereas when you talk about sectors like refinery, cement making, steel making, which are hard to abate sectors, and when you especially talk about older technologies versus newer technology at the same site, the impact could still be different.
Thank you. This one you actually have answered with Malaysia as a scenario that a country like Malaysia does not have the carbon pricing. So we use stakeholder engagement as part of approach to discuss what would be the appropriate carbon pricing to set that, right? Is there anything else you can elaborate on that for determining what could be used as internal carbon pricing and shadow carbon pricing for transition risk scenario analysis?
Yeah, so that's where I think a lot of things that we pick up is not only looking at interaction with the company, but also looking at what's been happening outside in other countries. So whether it's US or Europe, right? So they are moving faster in terms of transition space, energy transition space, and they have brought in a lot of policies and framework which are out there, which we read and understand. We work with a lot of those clients, and we try to see if and when certain developing countries, not only Malaysia, a lot of developing countries in Asia are still lagging behind in terms of policy development, right? So then we try to see that if a particular country takes a move towards looking at a climate change, emission reduction pathway, then potentially what sort of let's say carbon prices, right? What sort of carbon prices it may look to implement. So for instance, we have a very good example in South Africa, right? They have a carbon price already. They rely on a lot of global financing. So hence they were pushed, you can say, by global agencies to look at carbon pricing in their economy. So they introduced it in 2019. But at the same time, they have provided a lot of rebates, allowances, and a lot of businesses are only paying, let's say, 15-20% of the original carbon price. Now that's give us a good indication as to what could be a starting point in a country like Malaysia or other developing countries in Asia, which may look to support businesses because they don't want businesses to get a hit because of that. So and beyond that, we have studies like IEA conducts it on a regular basis. So there is Penang Institute study which talks about potentially what sort of carbon prices could be there. There are studies conducted by some of the institutes that we have come across in Malaysia looking at social cost of carbon emissions. So that's a very good proxy in terms of what sort of carbon price should government look at. But even beyond that, we also try to understand, what if a particular carbon price is levied in a particular country, let's say in Malaysia, then how government what sort of policies could government come up with to actually support this transition for companies not facing another carbon price to moving towards a framework where there is carbon price. So there are different factors that play a role, but we try to customize it based on the needs of the client. And of course, we explain what all approach that has been taken, what are the sources of data points, etc. And of course, workshop plays an important role because that's where we interact and tell them, see, these are the things that we are witnessing outside Malaysia. So Indonesia has introduced a carbon price, right? Thailand is looking to do so. They have a voluntary ETS already. So we also look at the countries in the adjacent areas. ASEAN plays an important role, right? If other countries in the region are looking to implement a policy, potentially Malaysia could look to implement it at a later stage. ASEAN can work together on some of these policies. So these factors play a role. We try to explain it to the client. Of course, we don't have a one number. Different clients come up with different responses, and we use that in our analysis then.
Thank you, Pralabh. You mentioned that different countries different. So one of the questions here is like countries like Netherlands, where they're facing a national crisis or like the national challenge of climate change. So they have a national scenario for physical risk. Are we aware that is there any at the national country level that has come up with localized transition scenario analysis? So for example, that aside from corporate, for industry association looking at that, are we aware of that? Is there transitional risk being looked at the country's ambition in terms of the energy projection and other local factors?
Yeah, very interesting, very interesting. No, so what I have come across is a lot of decarbonization pathways across some of the hard to abate sector studies that a lot of countries in European Union have done. But looking typically at the impact of transition risk on country, I haven't come across any study. I don't know, Trista, have you come across any of such study? But
No.
very interesting point, actually.
Yeah, very interesting point. I think for the national, they're driving in terms of policy and then setting up, for example, carbon trading to drive the development, but we actually haven't seen. And I guess if you adopt both the corporate and an asset level scenario into two-level analysis, when it comes to like a country, it's even more complex in terms like to what degree that you may be able to factor that, right? True, and then like you mentioned, at the asset level, quality of the data will be quite crucial to get the scenario analysis done rightly. So again, data confidentiality, and then how the government can, I see that government played a role more like driving those changes, promoting those changes. But then at the end, as much as government is setting the ambition, if the corporates, company, private sector are not, fulfilling the citizens' obligation, we're still at the same conversation. So that's why I think probably we haven't seen that, but it's certainly an interesting question that hopefully we may have some, maybe island countries in the South Pacific that would come out with that, which is also quite relevant for them, right?
Yeah, interesting. Yeah.
All right. We did have some questions to do with the earlier slide. What at one of your earlier slide, Pralabh, at the introduction, you did mention carbon price and the carbon boundaries. One of your comments was that carbon price is only impacting scope 1. So the question is why carbon price only impact scope 1 emission?
Well, it depends. Different countries have different approaches to it. So some of them cover scope 2 also. And as a matter of fact, there were some talks around covering scope 3, but of course, the problem with scope 3 is the estimation first of all, because you don't track everything. And there's huge scope in terms of how scope 3 emissions can be calculated. So definitely scope 3 is out of question at the moment in terms of carbon pricing. And of course, different governments have come out with the, avoiding double taxation policies. So where the market is mature, some of the markets are looking at taxing scope 1 and scope 2. Some of the markets are looking at scope 1 only. So depending on how much information and data is available, how much they can look at avoiding double taxation and everything. But it's a matter of time as to a proper policy would be out there in place. We are not sure what Malaysia will look at, but when we are trying to do analysis, we actually try to cover scope 1 and scope 2. And then beyond TCFD, right, when you talk about net zero pathways or carbon neutrality, then definitely most of the companies are looking at scope 1, scope 2 reduction. and looking to work on scope 3 emission reduction as well, right? So so coming back again to TCFD focus, right? So a lot of time we try to capture scope 1 and scope 2 when we're talking about carbon prices, but again, in the end, it will depend on the policies, and what we have realized potentially in developing countries, it may still be only scope 1 covered and may not be scope 2. So yeah, so we are just trying to look at a conservative, we are taking a conservative approach to look at a worst case scenario. But yeah, a lot will depend how the country, the policies will, policy framework will come out. So yeah.
Yeah, thank you. Makes sense. Yeah, so policy and also objective of the whole TCFD assessment. What do they want to get out of that, right?
Yeah.
Here's one. Links between transition risk and the associated financial impact may be opaque at times. What is your advice on addressing this issue?
Oh, linking.
Yeah.
The question is on how to link a particular climate attribute to financial impact.
Yeah, the linkage between transition risk and associated financial impact. So basically, how do we quantify the financial impact of transition risk? And then what is advice on addressing this issue? Because sometimes it may not be as transparent or like straightforward as it could be.
Yeah, yeah, it's a very subjective exercise at the moment, definitely, as I said. So depending on which scenario you pick up, the outcome would definitely differ. In fact, let's say if Trista and me are working on same scenario, right, for the same company, we will come out with a different output. That's the problem with the future forecast and using scenario analysis, because it totally depends on the underlying assumptions. So it's an important one, and that's where I think TCFD is looking at, probably looking at a little bit more standardization. But how will it do it? Still, we are still not aware. But when we look at these aspects, right? So of course, giving example of BP and Shell of the world, they have come up with their own scenarios, right? They have money to probably put in so much efforts and create their own scenarios by running general equilibrium models and computable general equilibrium models, and get the output. But when we talk about other companies, most of them actually rely on third parties which have already run scenarios and use that data to run how it will impact their businesses. So at least that standardization is in place. So if you're looking at third party, which is probably a neutral view rather than a company specific view, but yes, there is probably still more need to standardize it a bit, so that when you're comparing across different companies, in terms of what risk they feel are there for them from transition risk, you need to have more guidelines in place. So hopefully TCFD is working on that, and it may come up with some better guidelines. But addressing them today, you definitely need to you need to have clear assumptions out there once you have worked on these quantification of risks, so that you are aware, you are comfortable with those assumptions. And if you are willing to be transparent, then you can potentially tell it to the external world. So I'll give an example, and rather than not talking in a very subjective manner. So let's say you're looking at impact of market demand driving for lower emission products or greener products, so to say, right? So one approach is when you're looking at IEA numbers. So IEA provides you by 2040 or 2050 how much of the supply will come from greener products. So let's talk about cement sector, for instance. So IEA says that it's a hard to abate sector. Definitely there is a role for alternate materials to play. So instead of using clinker for cement, you actually end up using a little bit more calcine clay, limestone, fly ash, or whatever that you can use along with the clinker to make cement. But beyond that, most of the emissions will come down because of adoption of carbon capture and storage. Now, when we talk about CCS, and so when you look at the data from IEA, right, what you'll see is, let's say by, I think, if I'm not wrong, by 2040, 2050, they are looking at somewhere around 50 to 60% getting sourced, getting produced using carbon capture. So your emissions goes down. So what it basically means is that the greener products in the market would capture about 60 to 70% of the market by 2050. Now, if you are a conventional player, you have not adopted greener ways, so your market will shrink. So let's say right now your market is 100 million ton, all right, in your country. And by 2040, this 100 million ton is completely made up of conventional way of producing cement. using dry kiln, not wet kiln. I am assuming wet kiln to be 0. So this 100 million ton will reduce to only 40 million ton by 2040. So I'm not assuming any growth. Of course, when we talk about IEA numbers, they provide all these feedback as to how much cement production or consumption will increase globally and everything. But I'm just giving an example. So 100 million ton, and if by 2040 the market remains 100 million ton. So out of this, 60% is greener products, and 40 million tons are the conventional products. So one assumption is that you keep your market share same. So right now, if your market share is 10% of 100 million ton, which is 10 million ton, and you still continue to produce using conventional waste, so your market shrinks from 100 to 40, your share remains same, 10 million ton or 10%. So your volume would reduce to 4 million tons. So what we are trying to say here is that you tell the stakeholder that you have made an assumption that you are in a competitive space. Of course, there could be lower cost producer, high cost producer, but what you're trying to see is just the impact purely from climate point of view and not doing a competitor benchmarking. So what you're trying to see, if climate changes the demand for greener products, your market shrinks, your production will reduce from 10 million ton to 4 million ton by 2040 if you don't take any mitigation action. But whereas if you look to adopt let's say greener production of cement, your market size will remain the same. So if it is 100 to 100, your market will remain 10 to 10. So what we are trying to say is, based on, if you are not looking to adopt a mitigation option and you don't have greener products, your market shrinks. So you are not disclosing that your market is going to shrink by this much, but what you are trying to disclose is the assumptions that you have taken up. So if you want to be transparent, you can tell that your stakeholders that you are looking at a market share remaining same. You're not doing competitor benchmarking. You're just trying to analyze it from climate change perspective, how the impact could be there on the business. So that's, if you have consistent set of assumptions, right, at least that can make it a little bit more apple to apple comparison. So yeah, long answer, but again, it deserved some explanation. So hence I went on to this story.
Thank you. One more. For scenario analysis, can you please briefly explain how do we come up with the risk evaluation formula for the scenario analysis? Whether it is a short answer or is that actually quite complicated depending on the situation.
Well, yeah, I'll give it quickly. This time I will not elongate it. The quick answer is when you have quantified it, right? So typically when we look at risk metrics, or the risk management framework of a company, they say, okay, if a particular risk will have a less than 2.5% impact on operating profits, then we'll classify it as low risk. Whereas if it has an impact of more than 5% on EBITDA, then we classify it as medium risk. Or if it has an impact of more than 10% of your operating profits, then we classify it as a high risk. Right. This is how we typically, so I'm using 1 to 3 scale. Most of the companies have 1 to 5 scale. So once you have quantified, what you have done as part of quantification is you have identified how much, let's say, cost increase could be there. And ultimately you can estimate how much is the impact on your operating margins. And then you can compare that the impact with your risk management framework and see where you need to place it in your risk metrics.
Thank you. That's helpful. Here, one question to do with the product. Remember one of the polling questions that greener product demand from customer was one of the driver in transitional risk, right? So here the question is that related to carbon border adjustment. How can we categorize a product as a brown product since reporting is now still not mandatory? Will we have the required data, for example, when a company wants to do a life cycle assessment for their product to demonstrate their green?
Yes, very important question. But the only issue is at the moment there's no 100% clarity as to how EU will classify a product as a brown or a black product. I don't know what they will call it. It's just a terminology that I used. Now, so they would need to bring in a what do you say, right guidelines as to who can provide certification in terms of how much emissions that product has, and whether that certification would only be for the scope 1, scope 2, or for the life cycle assessment. That's another question which is not clear at the moment. So a lot of these guidelines need to be in place, and so by 2023 you actually need to start disclosing. The applicability of the text is only happening after 2026. So I think there is a 3-year phase where I think some of these guidelines will keep on refining based on the feedback from the various stakeholders. So I think next year we'll have much more clear guidelines as to what needs to be done. And 2023, the reporting will start, and 2026 there would be an additional levy. So probably a space where we need to have a key eye on, especially for the companies that have products going into EU. But it's again, a lot of things need to be made clear by EU. At the moment, it's not 100% clear.
Yeah, thank you. One last one before we pass back to Naveen for the closing. We've spent 2 days talking about TCFD, and we've explained what is the overall TCFD framework and also what is the physical risk versus transitional risk with great examples that Yang team has presented. So I think this question is quite good for the audience to read that bring home. Can we recommend any corporate reports in terms of TCFD that the audience can refer to understand the subject better? So maybe in your experience, Pralabh, coming across any of our clients or in your leisure reading TCFD reporting, since it's still not mandatory in most of the places in Asia Pacific, right? In fact, even though we see the trend of Hong Kong Exchange and Singapore Exchange to mandate this for the listed coal, but it's still much on a voluntary base. So any of the TCFD report that you think is comprehensive or is interesting and presentable that the audience can follow up to read further?
Yes. Well, as said, there is no standout TCFD report available on a standalone basis, I should say. Most of them are integrated as part of the integrated report or sustainability report. You'll find few pages on talking about the alignment with TCFD. Some of the good examples, of course, Shell, BP are now the good ones, but even in cement sector, I've seen Holcim has done a good job. BASF on the chemical side has a decent reporting on TCFD framework. In Malaysia, I probably need to get back. We have worked on some TCFD report ourselves, but probably need to check which ones are probably the right example to give out. So if you would be kind enough to drop in your contact details, probably we can get back to you on that. Just drop into Trista or me, and probably will drop you some more details once we have checked it internally. Yeah.
Thank you, Pralabh. Conscious of time, maybe we can pass back to Navina for some closing remarks. Thank you.
Thank you. Thanks very much, Pralabh and Trista. That was really very good. I've been receiving a lot of messages about how useful this session has been. This brings us to the end of the session. So the recordings as well as the slides will be made available for both yesterday's session as well as today's. And I think that we will have it on our website by Monday next week, and we'll send an email out to all participants to let you know where the link is and where you can find the information. We'll also have Trista and Pralabh's contact details in that email, so if you do want to reach out to them, you can do so. As you click leave to leave the session today, you'll get a feedback form, and we'll really appreciate if you could take the time to just give us your feedback so we'll know how to improve and what else we can deliver to you as workshops. So that brings us to the end of today's session. Thanks again, everyone, and goodbye.
Thank you. Take care. Stay safe. Goodbye.
Bye-bye.